Good morning, everybody. It is Friday, July 9th, 2021, a couple days after Independence Day, and I've been working on the very short list. And because I've gotten a lot of questions about SPACs, we are going to do a heck of a run through on our SPACs, including a couple of new ones, so that you see where I am going with all of this. But first, meet me in Las Vegas again. A couple of you came out to Las Vegas last week or 2 weeks ago, I guess it was now, and met me. And I'm going to be doing that again in a few weeks. I'll be playing in the online World Series of Poker, and I would love for you to come on out. I'll be buying breakfast again at Saltgrass at the Golden Nugget. I will be doing the presentation a different day, though. So if you'd like, just come out and have a little breakfast with me. It's going to be on Thursday morning, July 29th at 10 a.m. And I will buy breakfast for anybody who shows up. We can talk about investing, life, anything in between, health, baseball, Bucks in 6. It's going to happen, folks. The Bucks are going to end up winning the championship in 6 games. They're going to win the next 4, maybe. In any case, a little bit of house cleaning to do. If you haven't seen Shooter's swing trading notes, we've been coming up with a template that'll be easy to look at and work with. Really just annotated charts, and we're starting each week with risk on, risk off index notes so that we'll look at SPY, kind of know where the ranges are, QQQ, diamonds, if you want to trade those, small caps, and TLT. And I think from time to time we'll have other risk on, risk off charts in there. You'll have a few buy the dip ideas from the plug and plays, a few ride the trend ideas from the plug and plays. These are both important for folks who don't get in right away or for new members. Sell, scale out, raise stops. And then he's got some swing trading ideas that I think some of the more aggressive traders will be interested in. Scott's normal trades last anywhere from a few days to a few weeks. So that's not really my focus, but he is using the VSL and the ETF favorites list to find his ideas. One of them that he has here, and I think it makes a ton of sense. I have talked about the narrowing of the spread between high yield bonds and investment quality bonds, which tells me, in line with everything else that we've covered the last 2 webinars, that once high yield starts to crack, watch out. And that seems to be in a process right now. These lines are narrowing, and it really looks like it could fall off of a little cliff. And this is the area I would have looked at. He's got the blue line right where I would have looked. So we are different methodologies to get similar ideas. So I think it's a nice way of having 2 different approaches technically that can help you out. He's using primarily Elliott Wave. I primarily use cash flows because I just believe that more money in means higher prices and more money out means lower prices. Pretty logical to me, supply and demand. But I will be breaking this up as well. The risk on, risk off index notes I'll put into the ETF, the Global Trends ETF update every week, so that ETF subscribers, Global Trends ETF subscribers can get these too. And then I will use these in some investing quick thoughts. But if you're a rare member, you'll be able to get it all as a bundle. Otherwise, I'll slice it up for the type membership you are. If you're at margin of safety investing, a version of this will appear there too. So what do we really want to talk about today? Well, I want to talk about the new executive order a little bit that got passed today, got signed today. It's essentially everything that President Trump talked about and President Obama talked about. And now finally we're getting some action, which is to crack down a little bit on virtual monopolies and oligopolies. I've talked to you a lot about why monopolies and oligopolies are great for investors, but bad really for everybody else. And we've learned this throughout history. The thing with technology, though, is that we end up getting a lot of free stuff. At least that's the appearance. And people think, well, if I'm getting free stuff, why do I care if it's a monopoly? Because the reality is that it's not free. There is no free lunch. You're always giving up something. In the case of technology, you've given up rights to your data. You've given up rights to your healthcare information. You've given up financial rights. And you've taken it on the chin when it comes to the spread on taxes that you pay as a middle-class person versus what corporations and the super wealthy pay on their taxes. I know that there's this mantra out there that most of the taxes are paid by just a few percent of the people. And that's sort of true if you're only talking income taxes. But if you're talking Social Security taxes, and if you're talking really any type of excise fee as a percentage of income, most taxes actually come from the middle class. That's why we're not the ones that get the tax breaks. Now, as some of us knock on the door of getting maybe to the next level, becoming multimillionaires, I hope your mindset doesn't change. I hope you always think about when you had it tough, because ultimately the system is what gives us an opportunity. The system can also knock a lot of us down. It's happened to me. I've been broke a few times in my life. And I know, walking around the planet, as I have been doing now for a while, that the system, while it has doors, a lot of them are trap doors. So to promote competition, the Federal Trade Commission and the Office of the Comptroller of Currency, and it looks like the Securities and Exchange Commission even, are all going after predatory business practices. I don't want to get very political on that, but I want you to think about that in the context of investing. If the big companies are going to lose some of their big company advantages, which often suppress little companies and medium-sized companies from getting bigger, what does that mean? It means that probably some of the small and medium-sized companies are going to have an easier time becoming bigger, because companies like Facebook or Google or Amazon can't spend their way to crushing them or stealing their business outright. And while I benefit, just like you, from better delivery because of Amazon, better shopping experience, I think Shopify is right there too now. And we could see an internet that is much easier to shop, right? You don't have to aggregate everything towards one company like Amazon. And I'm guilty of it. I shop a lot on Amazon. But because my credit cards let me shop anywhere and get some points, starting to spread that out. What if your local companies get things to you in the same 1 or 2 days, cheaper, and it might be somebody that your kid plays softball with, or soccer, basketball, whatever. Could be a neighbor of yours. I think that the small companies and the businesses that serve the small companies have a heck of an opportunity. And there's a lot of other things that are going on that I think that we should really pay attention to as some of the small companies and mid-sized companies get larger. So what trends do we have to pay attention to? Obviously, all things technology, but also sustainability. Just showed a video before we went live from one of the investments that I'm going to talk about today. So I've gotten a lot of questions about SPACs, how I'm managing those. And how we started was I had a big basket of SPACs, many of them that weren't announcing a deal yet. They were still searching. But now, a good many of the SPACs out there that we were in have announced deals. And other ones that we weren't in have announced deals. And something weird is going on in the SPAC space. Nobody wants them. They spiked up and they crashed. We're in the trough of disillusionment with the SPACs. And it is about time that you took the time to understand what is going on, because we are looking at potential 3 baggers, 5 baggers, 10 baggers, and 20 baggers here. We're looking at companies that are valued at $1 billion, $2 billion, $3 billion, $5 billion, up to around 10 billion, that could be worth 20, 30, 40, 50 billion, or $100 billion this decade. Years ago, I used 3 years of Roth IRA conversions to buy all the shares I could of Exact Sciences. Ended up with almost 5,000 shares of Exact at the cost basis of about 3.5. That stock's 100 now, give or take. And I sold all my shares at 70 because I'm dumb. I took the 20 bagger. But I think there's a lot of those opportunities out there. 3 years ago on Seeking Alpha, I talked about GameStop and how they could transition their business from little physical stores to a handful of big stores that are experience-based and then do most of their business online and through memberships. Well, the new CEO comes in and that's exactly what they're going to do, and the stock is up 1 zillion %, mainly because it caught the attention of the millennials. In yesterday's webinar, I showed you a Morgan Stanley report that talked about how the millennials are now the money that moves the market. What have I been saying for over a year? Almost 2, but really the last year. So millennials are the marginal money. The money at the margin is what moves prices. Not the fixed units. It's the extra units that get sold or don't get sold. That's what changes price. That's what impacts supply and demand. So as the world shifts, we also have to keep in mind, what do the millennials like? That's another reason I've been dumping virtually everything fossil fuel related. The millennials don't like it. They're the marginal money. Why be stubborn? Why say but Exxon can transition? Why say but that dividend over at Shell they got cut 50%? Why say but Enbridge? They've got a big pipeline network. Yeah, but two of their pipelines are in danger of getting shut down, and that would be about 40% of their revenue. Oil's not evil. Who cares? Tired of the shut up. Unlearn. Stop being stubborn. Maybe nobody on this live presentation falls in that group. I bet almost nobody does. And I know that as this goes to YouTube and I start pushing this stuff a little bit through the social media, there's going to be people out there. But I made money on this 20 years ago. I don't give a fuck. So where should we be looking? Let's cover the SPACs that are now on the very short list. I've pulled them out of the SPAC category because they've actually announced deals. Let's fly through these. And I want you to think about the bigger picture here. And I've given some examples of what some of these stocks can do based on what other companies have done that are in similar spaces. And by understanding the businesses, you go, this could be a big deal. So let's start with the most hated one, WeWork. Everybody thinks, well, WeWork is just a shared workspace. And that's not all that great of a model. And they'd be kind of right. Not really right, but kind of right, that there's limited margins there. However, especially in the post-pandemic world, where a third of the people aren't getting a vaccine that will prevent the Delta variant of COVID, but I digress. The reality is that WeWork is doing something else. They have become a subscription-based company. We talk about that all the time. Recurring revenues. And why does this work? It's because a lot more people will subscribe than will actually use the space. So they can probably oversubscribe by 300 to 400% based on the space they have because people won't use it all at one time. It'd be very rare that they did. But here's one of the more interesting things to me about the company. As big corporations start to move their talent around the world, or at least let their talent work from wherever they are in the world, they're becoming renters rather than builders of space. You've seen Amazon. Amazon's a giant company, right? And they're building multiple headquarters. Other companies are saying, why would we spend all that money when we can just rent enough space for the 7 people that live in this city or 14 people that live in that city? And that's what these other companies are doing. They're creating flexible workspaces with hybrid schedules, and they're leasing from WeWork. That's not just because WeWork is a middleman on real estate to rent. It's because WeWork is supplying the technology and the data on the real estate in the local markets. What does that mean? It means that these companies are going to be tied to WeWork because WeWork just isn't a real estate agent for them. They're a technology agent. They're making sure that the workspaces have the technology and the data access that their talent needs. And they're providing insights on real estate markets in general at the commercial level. Over half of WeWork's business now is enterprise level, companies like this. And the roster is growing quickly. Future of work is hybrid. And I believe that. About a quarter of the people in the world right now, in the country, I think it's higher in the world, are working from home. I know that my fiance is looking for either a hybrid job or a remote job. Fully remote jobs are harder to find, unless you're some sort of an engineer or something like that. But the hybrid jobs, they're all over the place. He's weighing a couple of them now. WeWork isn't in Milwaukee right now, but they'll probably expand here. If you take a look at their map, there's a lot of expansion they can do. They'll just go where the workforce is, which is going to be probably 200 to 300 markets in America. But wait, what about Canada? What about Mexico? What about Europe, Asia? WeWork has the potential to become an incredibly scaled business with very high revenues, a combination of fee-based from small businesses and enterprise from big businesses. Now, they don't have a real good investor presentation, so I actually had to read this thing. Luckily, I have a AI that redlines it for me. So in going through this document, what I find is something that's very interesting. The company has an enterprise value of around $9 billion. Goldman Sachs thought it should go public a few years ago for $65 billion. What is the real value of this company? Probably somewhere in between in the short term, 20, 30 billion maybe. But what about the long term? What if they maintain a growth rate of 10 to 15%? That means 60 billion is in the cards, maybe a decade out. Would you be okay buying a company valued at 9 billion today and in 10 years have it be worth 60 billion? Are you okay with a 6x on your money in 10 years. But wait, there's more. You can sell options on this, sell puts, and sell calls, and right now get great premiums, even lower your cost basis more. And I'm fairly certain that they'll pay a dividend eventually. Now, this is SL Green Realty Corp. If you think of this as a traditional REIT, not super sexy, even though there's so many people out there that look at this and say, oh, I love REITs. I look at this chart and I'm like, I don't know what that is. Just some wavy thing. But this company here, CoStar, provides a lot of that commercial real estate information that I'm talking about with WeWork. WeWork's collecting a lot of data, a lot of information, and they're going to be able to expand into all these other things that CoStar does. And WeWork's going to have relationships with all the companies that are renters from them. What has CoStar stock done? Look at that. CoStar, with the asset light model that WeWork is developing in conjunction with their renting, is what CoStar did. 10x, actually a little bit more, 20x. So take this part of the business and combine it with this part of the business. 6x seems pretty reasonable now, doesn't it? I think you should own a little bit of BOX, BOWX, which is the company taking WeWork public again. More real estate, Open Door. Talked to you about this a couple of times. You should love this company. You should love it. Why? Because they are making real estate real competitive for the flippers and for other real estate services and real estate agents. Over 700,000 home purchase offers so far, and it's accelerating. And here's what they do. You can either sell your house to Open Door, they'll fix it up, and then they'll sell it. Basically, they're a flipper. But they're a flipper of 700,000 houses, 4 or 5 or 6. Or you can just list with Open Door, and they'll provide all the services of a traditional agent for a little bit less, but with a lot more exposure to the market. Because remember, people are selling to Open Door, they'll probably look on Open Door as well, buy their next house. So this is a very symbiotic circle. But the flipping, just think about the people that you know that have flipped houses and got rich. And they did it on 3 or 4 or 5 houses a year. The amount of revenue that these guys are going to generate is going to be off the charts. And it's already showing up. When Bloomberg throws something like this out there, you need to listen. When you start to see numbers like this, you have to go, huh. Remember, real estate is a hugely fragmented market, hugely fragmented. There's, in our way of investing, there's almost no limit to the upside here. They're 4.5 times bigger than the nearest competitors, and they're still tiny in the scope of the real estate market. So if you go through their presentation, I would like you to go through everybody's presentation before you invest. What you're going to find is that some of these companies have just massive, massive upside. So what's a company that's providing market data and home selling services that's done pretty well? Zillow. Open Door is actually eaten into them, I think. You need to own Open Door. Ajax, the Zoo merger. What are they doing? They want to transform the car buying experience in Europe, much like Carvana has been doing here. And it's not just used cars anymore. If you go through their highlights, what you see is that they're expanding throughout Europe. They're already in the UK. Germany and France are already being developed. Spain and Italy are next. Huge head start in Europe, growing pretty fast. And they're not going to have to add employees really for what they're doing. Between technology and logistics, they can handle quite a bit more volume, and they are consolidating the industry. The little guys are saying, let's join you. We can't beat you, so let's join you. So this is probably going to be a behemoth. This is what you should think about. They're growing faster than Carvana. And Carvana did this. Now, a lot of that's QE induced, even from here to here, pretty good, right? From 10-ish to 100-ish. Next one. Fast Acquisition Corp. I did a presentation from the Golden Nugget a few weeks ago. Fast Acquisition owns a lot of stuff. Fertitta Entertainment. That was the one I forgot to put up here. This is what they own. Landry's, Golden Nugget. There's a Golden Nugget pool. No, that's not the Golden Nugget pool. Which pool is that? Not sure. In any case, they own a lot of stuff. Golden Nugget. Now, not everything here is getting packed into that SPAC, but most of it is. And in a recent deal, Fertitta, in exchange for a little bit more ownership, he was going to own 60% of this. He's going to own 72% of it because he took some of these assets and he bundled it. Now, they don't have a great investor presentation either. So I had to read this thing. What I can tell you is that this company, with its online gaming, take a look at Golden Nugget Online Gaming, and with the Golden Nugget properties, casinos, and then with all of these restaurants, and if you've been out at a restaurant lately, you know it's busy. because a lot of the baby boomer businesses closed and aren't coming back. So the boomers decided, well, this is my retirement. I'm going to take the stimulus and the enhanced unemployment and I'm selling the property or leasing it out or something. It's going to take time for the restaurant industry to come back. And this guy jumped in there, $2 billion, and said, well, I'm going to open up more restaurants. We'll put a Rainforest Cafe here, or a Landry's or a Morton's or a Bubblegum Shrimp there. Primary competitor is a company like Caesars. They've done, right? In fact, Fertitta tried to buy Caesars, but Eldorado beat him to it. And I don't think that Fertitta will be able to buy Caesars unless he does some sort of a leverage buyout, in which case there will be a pop and a drop. So we'd have to pay attention to that. Ginkgo Bioworks, we own this now, right? Cell program. This is one of the primary growth engines of biotech out there, right? Cell programming, DNA programming, gene editing. CRISPR is known for that. They've done all right. AST Space Mobile, putting cell phone towers in the sky. Gigantic market. They did not get added to the Russell 2000 though. And I told you why in the chat. Does anybody remember why they didn't get added? Nobody remembers that from the chat? Teresa, you mentioned it in your highlights. No? Because they have founder shares that give super voting rights. Yeah, right, share ownership. So once again, Vince is on it. Vince might have to become the fundamental trends and margin of safety investing historian. But they're not in here, which means that someday they will be. So that's still more upside in the future. Because eventually the founder shares convert. And when the founder shares convert, then Russell will take them. But what market are they getting into? It's a trillion dollar marketplace. 5 billion mobile phones moving in and out of coverage, and half of the global population without 4 or 5G broadband yet. So these numbers can both double. This is the first and only space-based cellular broadband network that can connect directly to a mobile phone. That's important. So while Starlink can provide you with Wi-Fi at your house, essentially, you can take your phone anywhere, right? So do you want to have a router at home if you're living out on the range? Yeah, you do. But wouldn't you rather have your cell phone work anywhere? You always throw a signal from that if you have to. So the speed that Starlink delivers and that this is going to deliver, presuming the scientists can get over the last hurdle. And again, if they can't, this is going to end up taking a dive. But if they can, it's going to go up a lot, 10, 20, 30x. So even a small position in AST Space Mobile, just risk what you're willing to lose, 1%, 2%, something like that. And as we follow the news, and we will, when they do their next satellite test, which is coming up this year, and if it works, that they can get the signal directly to a cell phone, my oh my. And NASA, which initially was a little concerned about their giant satellites, has backed off because they're like, well, this is just such a huge unmet need that we want it out there. So what will probably happen is they'll end up with smaller satellites that work better. Why? That's how technology works. Who's invested in this company? I think it's interesting that American Tower isn't invested in this company. Why would they want to do that? Because they see what's coming. American Tower knows that it's uneconomical to build cell towers anywhere other than suburban and urban areas. Doesn't make sense to build it in the rest of the world. Well, towers just don't make sense. And 5G requires more towers closer together. So there has to be another way of delivering 5G to the rest of the planet, like 80 to 90% of it and all the water. And already, big companies hooking up with it. And what's interesting also is an e-commerce platform in Asia is an investor and customer. And when I say customer, these are all companies that are saying we'll sign a contract to be a customer, presuming it works. E-commerce. Think about the potential there. American Tower did this, right? 10x. Add some of the data and e-commerce to that to be even bigger. So now, here's a group of 4 SPACs that I'm going to introduce to you that are all satellite companies, different than AST Space Mobile. AST Space Mobile is for your cell phones, and then everything that's on your cell phone. These companies are data aggregation companies. They are software as a service companies based on data gathered from space. Navsite Holdings bought Spire. What does Spire do? High growth software as a service company, space-based data and analytics program from their low Earth orbit satellite system. There's not a good estimate of what percentage of global GDP can be impacted by this, but it's somewhere between 30 and 50% by best estimates. So think about global GDP, which is north of $100 trillion, and this is going to impact a third to half of it. As companies need data to manage logistics, for farming, for real estate construction. There's a million different things. Weather, NOAA already uses some of the services from these 4 companies. Go right down the list. So that video that I showed you beforehand, just kind of the tip of the iceberg. Spire, trading for around $10 a share. Black Sky, similar. Geospatial intelligence, imagery and data analytics. Pretty similar. Spire, another high growth company, software as a service. They see it as about a $40 billion addressable market. I see it in the trillions. This is their niche, though. So they're saying their niche, 40 billion. Again, I think it's quite a bit higher. And I think that this is undersold here. There's got a lot of people who want to get a big piece of this before this number gets reported to be much bigger. And again, this is their niche, what they're focusing on, but it's going to be in the hundreds of billions someday. Take a look at this presentation as well. Then we're going to move on to a SPAC that was announced just in the last week, Satellogic, space technology to improve life. Yeah, say what you want. All these companies use AI. CEO Cantor Fitzgerald was on Bloomberg the other day. That's how I even discovered this. I've only been studying this company for a week, but it's essentially similar to Black Sky, Inspire. A little bit different approach. SpaceX is launching their satellites. Software as a service. On a satellite as a service. You take a look at what they're doing when you visit. Think about the imagery that they can produce. Show you anything. And because of the AI, they can have different types of measurements. And this actually was the company that this is where this came from. Everybody's seen this now, right? The ship that turned in the Suez Canal a while back. This is their imagery. Look at that. You can almost read the ship. And in fact, you can zoom into it. You can actually read license plates with this stuff. They're saying $140 billion opportunity and what they're focused on. And again, I think that's going to expand a lot because there's going to be overlap for all these companies and where the data can be applied. So you're really looking at, let's say, $30 trillion of the global economy can be impacted by this. That means a lot of money is going to get spent on data that impacts that 30 or 40 or 50 trillion dollars of the global economy. And big companies are already buying this. Then the last one of the pack, the 4-pack of satellite data companies, satellite as a service companies, software as a service, is Planet. This is the one that I showed you the video from. Global daily Earth data. Again, geospatial, agriculture, state and local governments, sustainability, monitoring AI for the analytics. So think about what software as a service has done in the last decade or so. Think about what all this data can be used for, basically to move most of the economy, to help move us towards sustainability. This is the next step in big data, and this is somewhere between 10 and 15 times bigger than the existing big data. The amount of data that's going to be generated from these types of companies is literally 10 to 15 times, by most estimates I've read, bigger than what Amazon, Google, and Facebook are already doing. Think about how gigantic that could be. All 4 of these companies could be as big as Google, Facebook, Microsoft, and Apple down the road. These could be trillion-dollar stocks. And of course, they probably won't be, not all of them. And I do expect a lot of mergers and acquisitions because ultimately the market will shake itself out. There's a little bit of a rush out there. If you take a look at the numbers of satellites that companies are saying they want to put up there, the government's not going to let them do it. So a lot of companies are going to have to merge. So you'll see a little bit of dilution here on the mergers from time to time. But ultimately, these 4 companies have first mover advantage. They all have satellites in the air. Planet has a pretty big network. I believe it's 300 satellites. And then who was it they had 200? Is that Spire? Black Sky also has them up there. And interestingly, Planet makes their own satellites. I don't think that's tremendously important, but it means that they can be a contractor to other companies as well. So again, I'd ask you to watch this video again if you didn't see it at the start, and consider software as a service. Anybody have a company that they'd want to see the chart on as software as a service? How about a company that's less than 20 years old? It's already on the Dow. This is Salesforce.com or Salesforce. Man, they do call themselves .com now, right? Salesforce.com. Intenish, 250 year, 25 bagger. It's gotten so big, got put on the Dow. I think, is this who replaced Exxon? I think so. And if so, I just got to rip on Exxon again. So that's great. One of those satellite companies that I just showed you is going to end up on the Dow Jones Industrial Average. Take that to the bank. Might take 10 or 20 years, what's going to happen. And it might be a derivative company, right? A post-merger company. One of those companies is going to be worth 500 billion or more. So buy them all as a basket, your own little space SPAC. ETF, put a little AST Space Mobile in there too. So that's $1 trillion market. And just hold them for a while. I'm selling puts on the ones I can. There's not a put market for Planet or Satellogic yet, so there will be eventually. All these SPACs are small companies that can become much, much, much bigger. It is a combination of a changing global economy from technology, shifts in lifestyle, sustainability, and the idea that AI, 5G, the Internet of Things, space, the climate, all these things are going to end up working together. It's going to take a generation, but these are the types of stocks that in 5 years you're going to go, oh, that's done pretty well. And in 10 years or 20 years, you're going to look back and go, my God, I'm glad I threw a couple percent in there. All these companies are going public via SPAC. All the symbols are in the VSL, and you should own 1 or 2%. So EFV is one of the symbols, CF Acquisition Corp, right? They're all trading for about 10. DMYQ. Okay. So I'm going to actually write an article. Title will be something along satellite software as a service companies. SPACs, I'll throw SPACs in there just to drive some people away. But they're all right around $10 a share. Basically trading for cash value. How often can you buy a company for book? So not only are these hyper growth companies, but they're meeting the definition, right, of a net. So all these companies are cheap. They're all trading for around $10. All of them have the possibility of going to 3 figures. I think WeWork has probably got the least potential. And I think that could only, a triple to 6x, 3x to 6x on WeWork. All the other ones I think have the potential for 10x. Some of them are going to be more. Back when I talked about Exact Sciences in 2008, 9, and 10, I said this is a stock that can go to 100 and it was trading at 3 at the time. People told me I was stupid. Well, I made $750,000 on that stock. You don't have to have a lot of big winners to change your life. Just avoid the big losers. Don't trade yourself out of big winners. I made that mistake a lot of times. Bought PayPal at the IPO, sold it around 100. Whoops. Now I'm trying to figure out a way to get back in. Bought Facebook when it was in the 20s. I told everybody to buy it on MarketWatch. Sold it around 100. Oops. I will say, the early X's are easier to make, right? From 20 to 100 is 5X. Big money is made with small companies and mid-sized companies to become big and really big. Buy the basket of SPACs. On Monday, I'm going to cover the rest of the plug and play stocks. All of these are on plug and play on the growth side. So all of these are in the plug and play growth because they're all companies. They're not just SPACs anymore. They're companies. And all of them have huge upside. So if you're a growth investor, huge upside. If you're an income investor, all the ones that trade options, the put selling is fat and the call selling is fat. You could probably make 20% a year just selling the options on these things. Oh, and by the way, Reddit's all over these. They don't like WeWork. They like the other ones. But they don't understand WeWork. They think it's what it was in the past. They don't understand that it's enterprise and data now. All right, have a great weekend. And remember, Bucks and 6.